Welcome everybody to the March Ellsworth Advisors monthly client video. Today is April 4th, 2019, and I'm Kelly Kuennen. This is Cameron Miele with Ellsworth Advisors. Today we're going to talk a little bit about what's been going on in the economy through the first quarter and through for the month of March. Also give you an update on how the portfolios have performed, how the markets have performed, and a little bit of insight as to what we're thinking moving forward over the next couple months, different positioning we're taking, and a little bit of update on what's going on here in tax season. So to start things off today, I'm going to have Cameron kind of start us off with a little bit of an economic rundown, and we'll go from there.
All right, perfect. Thank you, Kelly. Hope everyone is doing well. You've heard me say this for the last 2 months, but the U.S. economy remains very strong. We are seeing a global slowdown in all of the major economies, particularly in Asia and Europe, but the U.S. economy, the world's largest economy at $18 trillion, remains growing at a healthy clip. With that being said, I think everybody sees the writing on the walls that this has been the longest bull market in history. Corporate profits are starting to slow a bit. Energy inflation is starting to creep in. Employment is now at a 49-year low, so we're starting to see wage inflation. All of that's going to eat into corporate profits, and as corporate profits begin to slow down, they're still growing, but not growing at the same expectations as before. As we see those profits start to slow down, we will see the economy start to turn a little bit south. We don't expect a recession in 2019. Most major economists don't expect a recession in 2019, so we still see an opportunity to make money, to have returns, to invest in great companies. But there are other concerns out there of wage inflation, energy inflation, slowing corporate profits, and the long-term debt situation in the U.S. is obviously the elephant in the room. But right now, we kind of see slow and steady through the rest of 2019 as the U.S. economy continues to chug along at an impressive rate.
I agree with a lot with what Cameron's saying, and a lot of those features he mentioned, slowing profits, high employment numbers, these are all typically characteristics of a late cycle economy where we're getting towards the end of the expansion. Ultimately, things will roll over. The problem is timing. Nobody knows exactly. We can stay in this state for a long time.
Yes, we can.
But when does it roll over? Who knows? Like Cameron mentioned, nobody's really expecting a recession to begin in 2019. The numbers just don't quite add up. A lot of people are definitely forecasting 2020. The problem with everybody forecasting 2020, if things were to come to fruition in 2020, this would be the most forecasted recession in the history of the world. So things usually don't work out that way.
And if it doesn't happen in 2020, everybody's
forecasting 2021. So who knows how long this thing can trug on. The reality is...
You know, fun fact for our investors, they might not know this, and I'm not sure if we brought this up, but when you look at bull markets, just because we're in a long bull market doesn't mean said bull market has to end.
Exactly.
Australia has been in a 25-year bull market this year, which is utterly amazing.
Right.
So,
yeah, bull markets don't die of old age, neither do expansions in the economy. And the reality is it's always generally caused by something. Maybe it's inflation, a misstep by the Fed. Right now, things that have been kind of weighing on the economy, especially on the markets, which really came to a head in December when we saw the big pullback, the trade issues with China, and then some of the verbiage coming out of the Fed. The Fed issues have kind of been taken off the table, really from a standpoint of it seems like they're taking a more dovish stance. And I really believe that they don't want to be blamed for the recession. If they keep on raising interest rates too aggressively while the rest of the world has low interest rates, that very well could invert the yield curve to a point that could throw us into recession. And once again, I don't think the Fed wants to be blamed for that. So they've taken their foot off the gas, kind of waiting for the rest of the world to catch up. And that's one of the wild cards that could actually be a positive surprise. If Europe and China are hitting their valley in their economic performance and they're starting to improve a little bit or aren't going to get any worse, that could actually spur this expansion even further, which would obviously drive the equity markets further along. The other side of it is hey, they're going to get even slower, which is going to drag us into a recession or even slower economic growth. or the Fed gets too aggressive, other central banks get too aggressive, and that could be what tips us into recession. In general, I think our next recession won't be a severe recession. Very unlikely it'll be like 2008 to 2009 that was driven by a financial crisis, but it'll definitely be an economic slowdown, and with that comes a major dislocation in the stock market. So that kind of leads us into what's been going on in the stock market and kind of how the portfolios are doing, what they did last month, and how we're positioned moving forward through this kind of next phase of where we're at in this economic investing cycle. Year to date, S&P 500 up just over, and this is through the end of March. Year to date, the S&P was up just over 13%, 13.07%. Month of March, up 1.79%. The Dow Jones, not quite as strong. Year to date, Dow is up 11.15%. For the month of March, 0.05. So the Dow significantly underperformed the S&P 500. The Dow, once again, is only 30 stocks. They're weighted according to price. One of the stocks that was definitely challenged in the Dow last month was Boeing. Believe it or not, Boeing's up year to date, but gave some back. That's why the Dow was hurt a little bit in March compared to the S&P. On the international front, the EAFA, which is basically the developed world or developed countries, year to date 9.98%, so almost 10%. So we've seen some good recovery in the international stocks for the month of March, 0.63, so somewhere between the S&P and the Dow, kind of in line. Emerging markets year to date 9.92% and 0.84% for the month, so kind of in line with the major markets. Typically, in a strong market, emerging markets does outperform, but I think March was kind of a flattening month. We had a lot of upward movement in January and February. March was a little bit more of a breather month. We saw a little bit of volatility. For the most part, the markets are back to where they were going into December. And going back even further, this will be the third time we've hit these levels. So it's now December of 18 and then December of 17. So in general, since the end of December 17 till now, the market really hasn't, it's gone a lot of different places, but it's ended up in the same spot. So it's gone higher, lower, and we're right back to where we were December 2017. From a portfolio standpoint, our largest portfolio for clients, where almost everybody's in this portfolio, the growth with income portfolio, for the year, it is up 8.46%. So compared to 13% on the S&P, we only have about 55% equity exposure in there, so I think that portfolio is working pretty well. We have a little bit of commodity exposure that helped us for the month. Honeywell was strong, Cisco was strong. We picked up some NVIDIA a couple months ago at a low point, so that had good performance. Nike was strong, Apple strong, and finally commodities are up about 9% year to date. We've been waiting for those to work a little bit, maybe a sign of inflation. There are some signs out there, so one of our hedges in the portfolio has worked out pretty well. Commodities up, gold not so much. Gold's actually down a little bit year to date, which is an interesting dynamic. That's why we're in broad-based commodities in addition to our gold position. In our price potential portfolio, lagging a little bit this year, 9.24% year to date. For the month, 0.53, so kind of right between the S&P and the Dow. Our dividend yield portfolio, 10.69% year to date. Last month, 1.09. We do hold Boeing in that dividend yield portfolio, so that probably took away from some of the performance in March. Still up 1.07%, which is pretty solid. British American Tobacco was up strong. Paychex was up strong. Boeing year to date is still, like I said, up 18%, but down in March, actually down 13% in March. So if those planes didn't crash, Boeing would probably be up about 30% year to date. Last month, Kimberly-Clark was up pretty strong too. No big standouts really in the month of March, except for Apple and NVIDIA in our growth with income portfolio. Our small cap portfolio up 11.94%. Last month, that portfolio actually gave up about 3.22%, so about 3% is what it gave up. We had some volatility early in the month, little recovery mid-month, things pulled back towards the end of the month. Probably the most damage was done, or where the most pain was felt, was in the small cap universe, which isn't surprising. They're smaller stocks, lower volume, you have bigger swings, but in general, they're performing really, actually this portfolio is performing slightly outperforming the small cap index, so we've been pretty happy with it. But as always, you have big swings in that small cap portfolio. Overall, when we look at the markets, valuations seem to be on the higher side, I would call it within the range. Going into December, a lot of argument was they're definitely overvalued, and in a normal interest rate environment, I would call the equity market overvalued. And once again, what we're trying to do with the portfolios is stick towards more reasonably valued stocks. And that's really from the context of we want to be invested to be able to participate in the upside of the market. We're not in the highest priced stocks or the highest valued stocks because those are going to be most susceptible to any kind of misstep by the Fed or any kind of weakening in the economy. And the way the markets work really ever since 2008, 2009, initial shocks generally affect everybody. The key is we want to be prepared where, we know if there is a big shock to the market, we're going to feel the immediate pain, but we want to be in companies, we want to be in the stocks that should be able to pull out as quickly as possible. And once again, that's kind of going back to more fundamental valuations or what is fundamentally a sound valuation in case we get back into a more fundamental regime, which may or may not happen before the end of this cycle. I don't think it's going to happen before the end of the cycle. It's just a matter of when the end of the cycle, but we want to be prepared for when the cycle's over, be in a good spot to recover in a relatively short time frame versus taking 4, 5, 6 years to recover through a major downturn, which will happen eventually, but we don't know at what level. So we want to keep that exposure. We've done a lot of risk management in the portfolios for that. And the other thing around handling the volatility that really ever since the beginning of the year or really late last year is we've concentrated on really in knowing where our clients are positioned, each of our individual clients' different situations, having enough liquidity or dollars in stable areas so that if something does come up quickly, we can ride through any kind of downturn. In December, it was a relatively short downturn where we had a 20% drop, and 3 months later, we're basically back to where we were. That's a short time frame, but fortunately, because of our cash management for the individual clients, we were able to avoid having to sell out at major losses or at losses. So that's kind of the key moving forward, and that's going to be the approach I'm going to take until we get through the end of this cycle. So we need to keep enough dry powder, whether it's for opportunities or for needs, but also stay invested, but I think in a little more prudent manner, a little more conservative manner when we do have that exposure to the equity market. Any comments around what's been going on?
Actually, I think, excuse me, I think your story really relates to active versus passive management. And that's something I wanted to bring up. I got a story that I think will resonate with a lot of our investors. So I was meeting a gentleman, this is a gentleman in his mid-50s, he's a business owner. We met about 2 weeks ago. He's got the majority of his net worth tied up in his company, just had a significant liquidity event, sold off a division of his business, so he came into some money, and he's trying to decide how to invest it. And so we were sitting down, he's not an existing client, we're sitting down and basically talking about what Ellsworth does, how we manage money, how we work to advise our clients on all facets of their financial world. And he finally stopped me and he said, well, I've always been taught that you should take your money, put it in an instrument like Vanguard's S&P 500 index and leave it there and just let it ride out and you'll be happy. I looked him in the eyes and I said, yeah, that's a great strategy for a lot of people. A lot of people don't have the stomach for the ups and downs. They don't have the stomach for the volatility. So they'd rather just put that money away and let it go, check their statements every quarter. And if you do that over time, you should be happy. The problem with that is when you're talking about something like the S&P 500, you are talking about the stock market. The S&P 500 today is the 500 largest publicly traded companies in the United States. It's 80% of the market value of all publicly traded companies. So if you want a market return, that's absolutely the way you should invest. It's a low-cost way of investing. Your market's going to be up, your portfolio is going to be up. Market's going to be down, your portfolio is going to be down. In a rising situation like we saw in the first quarter when the S&P is up 13%, Everybody in the S&P 500 looks like a genius. The problem with that is, think about the 500 largest stocks in the U.S. Generic example, there are probably 75 that have great fundamentals that I want to own. There's another couple of hundred that have mediocre fundamentals. I don't really want to own them at this point. Maybe their valuations come down and they become an attractive play. And then there are, frankly, many companies that the fundamentals are terrible, and I don't want to own them. I'll give you an example. General Electric. General Electric was founded in 1892. For about the last 125 years, General Electric has been a great story. It's an American company. It's the quintessential American company. It's been a great company to own. If you've owned General Electric over the long term, you've done very well. However, in the last 5 years, General Electric has not been a good stock to own. And just because it's a large company, because it's got 100 years of earnings growth behind it and market capitalization growth behind it, doesn't mean it's a company you want to own today. Fundamentals with General Electric. Recent dividend cuts, their cash generation is down, the cash on the balance sheet is down, their liabilities are up, their earnings are in decline. They've sold multiple divisions trying to raise cash. They've had multiple changes in the board, in management, and most importantly, in the CEO role. So, is General Electric a big company? Yes, it's a very big company. That's why it's in the S&P 500. Do I want to own General Electric today? No, I don't. And so that's why I think you're going to see in volatile markets, in down markets, the active management is historically going to prove to be the better outcome. And so that's why, as Kelly said, we focus on more concentrated portfolios, high quality companies, great balance sheets, great cash conversion. Those companies might not perform exactly to the upside with the S&P 500 because you've got companies like Amazon or Facebook that could be up 8, 9, 10 points a day. But we expect our companies to move up well when the market's up. We expect them to decline less, hopefully, when the market's down. And when the market recovers, we expect them to be the leaders in recovery. So that's why active management, in my opinion, makes sense. And that's why we do what we do.
And one note on the index, it's looking at the S&P 500 largest publicly traded companies. But one little feature of it that a lot of people don't realize is how those stocks are weighted in the index. The bigger the company, the heavier the weighting. So what happens is the index is being driven by the characteristic of those largest companies. And that's where, at least in this environment, I'm most concerned about valuations. We really look at investments or investing stocks as ownership in a business versus stocks are the whole market. And if you're evaluating stocks on, is this a business I want to own, you may get a different answer than, hey, I want to own every single company out there. So that's why philosophically we've stuck with, less of an indexing approach, but rather bottom up. Here's a company, here's what it's doing, here's what the numbers look like, here's their growth prospects, this is the culture of the company, is this a company we want to be involved with? That's really what's driving the equity side of our investment decisions at this point in time. And at the late cycle, like I said before, I think valuations are going to be critical because they'll matter the most when things get the worst. On the upside, everything works. And how much upside is left, we don't know. I think there's some more room to go. Sentiment has been, I would say, neutral. You don't have a lot of people rushing into the market, but then again, you don't have a lot of people rushing out of the market. So we're kind of in this neutral area where when you generally see a market top, you have a lot of exuberance. Everybody wants to buy, 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 buy. That's not happening, so it's hard to have a major top without that phenomena happening. That can change quickly. You have a couple more really strong months, get some good news out of the trade situation, get some growth out of Europe and China. Maybe everybody starts rushing in. That could be the last hurrah. We'll see how things play out over the next couple months.
I also don't see what's interesting is when you think about 1999, the tech bubble, you think about 2008, the financial crisis, there was a mortgage bubble. Really, other than the debt situation with the U.S. government, I don't see a bubble out there right now. And usually bubbles pop before you even realize there is a bubble, but...
Right, yeah. Governmental debt, a completely different situation because we are a sovereign country. We have a non-convertible currency. We are the reserve currency of the world, so we can debate, government debt all day long. When you look at debt, the one area that's popped up more, well, in the last year or so, last year and a half, is the whole student debt. But unlike mortgage debt, student debt hasn't been turned into a bunch of derivatives on
Securities that
derivatives,
you're selling,
derivatives on derivatives. People hold, student loan bonds, but they're part of diversified portfolios. Banks aren't over-concentrated. So even if you saw a problem in student loans or in defaults, very unlikely it's going to take a bank out, or it's not going to stress the financial situation. Yeah, you're going to see, some pullback in bonds, but I don't think it's going to destroy anything. One area that a lot of people talk about now is the level of corporate debt, which is historically high, but then again, the size of corporate America is historically high. Interest rates are low, and if you're a business owner, you're a corporation, if you can get cheap financing,
very efficient form of financing.
Why not? You're always going to have your more aggressive companies, your companies that are financially weaker. Yeah, some of those are definitely going to fall by the wayside come the next recession. You're going to have defaults, but once again, I don't think all that debt's concentrated in one place. So once again, I don't see that causing, a problem. I think our next recession is a run-of-the-mill recession, a general slowdown, and things, move forward. How they look moving forward, that's a question. I think we're, a couple of recessions away from the Great Reset where all the rules change.
Yeah, absolutely.
So that's kind of the outlook. One other thing I want to touch on, I kind of referred to it a little bit earlier. 2 weeks from, Monday? Last Monday
is tax time.
Is tax day. With the tax law changes, this is the first time we're going through what all these new rules mean to people. And because of the government shutdown, late reporting by companies for K-1s and so forth, it seems like a lot of tax preparers are a little bit behind the 8 ball. I've had a handful of clients who have already gotten their tax returns back, and a lot of these have been retired clients. And what we found there is they've been pleasantly surprised, where they either overpaid because they're making quarterly payments, or the amount we're withholding on IRAs. We were assuming older tax brackets, so they've had some pleasant surprises. From a business owner standpoint, I don't know one business owner who's gotten his taxes back, or where they've gotten their taxes back, to see how the new tax law effects have affected business owners. From clients who are employees, Cam, what have you been hearing there? Because I've been hearing a mixed message.
The message I've heard, and I think this has been well documented in the media, is that people recognize that their taxes have gone down, but their refunds or their expected refunds have also gone down. And it should be intuitive, but a lot of people aren't thinking this way. If you paid less last year, your refund should go down. So if you're expecting, hopefully you're not, but if you're expecting that big refund check that you got last year, and that's how you're financing your lifestyle, you might be rudely surprised.
Don't plan on it. I think especially in the W-2 world, there was talk out there that the way they were calculating withholdings was incorrect early in the year, or early last year, so that could be some surprises coming down the pipe. I think in general, though, what we've seen, taxes are lower, especially in this region. We don't have a lot of clients on the East Coast where they have a lot of state and local tax deductions. Those people, I think, are going to, could very well be feeling some pain. Here in Ohio, in general, mostly neutral, a lot of good surprises. On your highest end of income earners, I think that's where neutral, maybe a little bit of pain, but in general, I don't think tax time should be too difficult this year. In general, I think most clients have gotten all the documents they've needed. If you do have questions on that, or if you want to have your CPAs reach out to us in trying to find documents or needing documents, do not hesitate to call. We should be able to assist in getting the documents you need. So that's kind of where we're at. April 4th, spring is finally here. Weather's breaking.
Finally sprung.
Tribe started playing, so just heading into spring and summer. Other than that, April's generally a quiet month. Hopefully it's the same this year, and kind of keep chugging along. If you have any questions or need anything, please reach out to us, and we'll get back to you as soon as possible. We want to thank you for joining us, and have a great month.
Thanks, everybody.
Thank you.